Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Mr. Daniel Yu, Global Strategist at Yuanta Securities. Mr. Yu, good afternoon. Thank you for coming on today.
Good afternoon.
Well, stocks on Wall Street were back down on Thursday on fears that Russia is going to invade Ukraine. In fact, it was the biggest point decline for the Dow since November. President Biden warning that the risk of an invasion is still very high. What's the story in the global equity markets?
Yes, if you look at the U.S. market, it declined quite sharply. Dow was down by almost 1.8%. S&P was down by over 2%, and NASDAQ almost close to 3%, 2.9%. Clearly, this was due to the uncertainty about the Russia issue. As the President Biden of the U.S. have mentioned that Russia could invade Ukraine in the coming days. Earlier, NATO has stated that it had not seen Russia pulling back troops from the Ukraine borders, while the Russian news reported that there has been some firing in the eastern Ukraine, and obviously these concerns piled up, affecting the overall uncertainty in the market. This volatility could continue in the future as long as this issue is not settled. However, though, as the both parties from the U.S. and Russia is expected to meet, there's been some rising trend of the futures market. We did see the U.S. market recovering in the futures market by around 0.5% to 0.8%, depending on the index. We are looking at also the monetary policy front, where the St. Louis Fed President James Bullard is keep talking about hawkish stance in regards to interest rate, that in order to fight the inflation, raising interest rate fast is most important. That's what he's been saying. But that's just what he's been saying. In terms of what's going to happen in terms of the rate hike, this has not been decided. We will see what happens in the March 16th. If you look at the overall Fed monitor trend, we see that the rate rise by 0.25% on the March 16th. The possibility has been rising since a few days ago on the day of the inflation number coming out. So we think the speed is expected as what we've been told, which is about 3 to 4 times rate hike. The market is right now expecting 5 times rate hike plus within this year.
Well, today in Korea, the market started out quite a bit lower for many of the same reasons, but by this afternoon, they'd recovered all of that. For the KOSDAQ, a decent-sized gain, though many of the biggest names were still down. Tell us about the domestic market.
Yes, KOSPI actually closed flat from the overall 1% decline of earlier trading days. It closed at 0.02% flat, up flat pretty much. And the KOSDAQ showed quite a bit of rise by 0.86% today. If you look at the overall foreign investors, they continue to be a net seller of the Korean market, selling about 151 billion of KOSPI and also selling about 159.9 billion. Clearly, the net selling is much more heavier on the KOSDAQ index related companies. However, the institutional investors are the buyers, biggest buyers. Retail investors are slightly supporting overall. What we see is that based on the worst case scenario on the residual income models, we expect the KOSPI, probably the bottom number is expected to be around 2,700. That is worst case applied, and KOSDAQ around 870. So if you look at the overall market, it did close above that number. We did touch well below that number. But anyway, today KOSPI is at 12,744. KOSDAQ is at 882, which means that a lot of the negativity or uncertainty about the global market is already affected the market itself, and that KOSPI is probably in a good position to rebound. And if we look at the chart trend, we did see that the double bottoming and then start to see markets going up. And if you look at the overall earnings numbers and evaluation remains to be very cheap. And if that's the case, with the U.S. market stabilizing in the future, most likely in second quarter, KOSDAQ and KOSDAQ will be probably in good positions to recover. But overall, right now, the volatility remains quite high because Korea is highly oil dependent in terms of the import, and cost of the goods are rising and affecting trade surpluses for the time being.
And the possibility of a war in Ukraine is causing a lot of the volatility in the markets right now. You could say that perhaps there was enough volatility already with the question of monetary policy. Maybe hard to say, but what do you make of the volatility in terms of geopolitical risk and maybe how long you see it being elevated like this?
Well, I mean, the issue between Ukraine and Russia has been an ongoing process ever since the Soviet Union split up. Given the fact that they're raising this issue right at the beginning of spring period, it's probably unlikely that actual war can happen. It's more like a political situation, so geopolitical issues are affecting the overall uncertainties. But actually having war itself would be very negative for the Russian government itself, and also will be negative for the Eastern and Western Europe, and as well as U.S., given the fact that that kind of uncertainty will cause the cost of goods to rise significantly in terms of oils and various other materials. So this is just quite a bit of a so-called similar period like Cold War era where the actual war doesn't happen, but there's continuation of negotiation happening. We think that that kind of trend could happen for the time being. But nevertheless, the dependency on the oil and dependency on the raw materials of Russia remains to be very high. So we think that that will cause the inflation numbers to remain to be fairly high as long as this geopolitical uncertainty remains. In overall, we need to see this settle down. If that's the case, then a lot of things would be changing in terms of directions and affecting positively in terms of the equity market. But for the time being, this kind of volatility can continue as long as this uncertainty of political issue or geopolitical issue remains at the current point in time.
Well, finally, Mr. Yu, if we could talk a little bit more about oil prices. They have come down as it appears that negotiators are getting closer to a deal that would get Iranian crude back on the market. West Texas Intermediate down by about $1.90, coming down from the high it reached earlier this week. What's happening with oil prices?
Right. It's all about supply and demand thing. If you think that there is not going to be a war between Ukraine and Russia, then the supply side is not going to be long-term uncertain. It will be more of a short-term, depending on the political issues. So on top of that, with the news about the Iranian oil might be coming into the market as the nuclear deal agreement can actually happen in a short period of time, then the supply jumps, and therefore the oil price will be in a good position to fall. Given the fact that it is well above $90 per barrel, which has been record high since 2011 or so. So we saw the Brent futures and the WTI all falling over 2%. Right now, the oil price remain at right around $90 to $91 per barrel, which is quite a bit of decline from the peak of close to $95 per barrel. We think that the speculation on this oil prices would continue in the future, given that the oil is a highly leveraged product where people can shoot for any type of directions in terms of up or down. So for the time being, as long as this uncertainty regarding the supply from the Russia side remains to be high, then, of course, that causes the supply and demand pictures to be shifted, skewed, and that's why the volatility in oil price continues to be there. Overall, though, if the economy is in the right direction and that uncertainty on geopolitical issues settles, then oil will be in a direction to fall and probably stabilize at around $70 to $75 per barrel in a longer-term basis, on the basis that the economy is changing and the economy is continuing to be quite fairly strong. So we think that the volatility is expected. However, betting on oil prices rising might be too short-term lived or quite uncertain in terms of the direction-wise. Rather, we think that we need to be focusing on companies related to the oil, showing a very decent performance based on even at $70, $80 per barrel of oil prices. That might include just purchasing ETF related to oil. XOP would be the one that are mostly widely used at the current point in time. All in all, we think that this kind of volatility is expected to remain for the time being until probably in the second quarter. This kind of volatility should be it's something that will remain for the time being, and we should be using that volatility as a buying opportunity for some fundamentally strong companies right now.
Got it. All right, Mr. Yu, we'll leave it there for today. Thank you, as always, for sharing your insights with us, and have a great weekend.
Thank you. You too.